for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thank you very much, Carolyn. We normally spend a lot of time looking at data on jobs in order to get a feel for the strength of demand in real estate markets. It's been difficult during the pandemic because of the large loss of jobs in all local markets. Comparing a market with a 20% loss to another with only a 15% loss doesn't make much sense. The overall job situation continued to be useful through the pandemic, both as a marker for when and how a recovery might take place and to see what kinds of jobs were lost, which let us see that homeowners and renters were not equally affected. We're now at a point in the recovery where job data can tell us some additional things specific to local markets. First, which ones are recovering faster? And second, which ones are likely to have long-term job losses that will mean lower demand for housing during the next few years? One other thing we'll look at today that's also affected by jobs, but not directly, is the recent surge in home prices in some local markets. First, the national situation, and it's very good. Since the beginning of vaccinations early this year, the loss of jobs compared to pre-COVID has steadily shrunk. The pandemic is still around, especially with the new Delta variant, but it's easy to imagine that by the end of the year, this chart will be in positive territory. Here's one of the main reasons. Business services is one of the largest sectors of the economy, and it's the most important measure of general business activity. One of the key indicators for local market recovery is how well local business services jobs are doing. Another sector that's doing even better, although it's much smaller, is construction. And here it's mainly home construction that's connected to the surge in home prices. Retail jobs also have largely recovered, although the pre-pandemic situation suggests we can't expect much growth in this sector. Jobs in finance also contribute to the current overall improvement. It's mainly jobs in real estate finance, again connected to the home buying surge, that account for the better performance. Jobs at restaurants also continue to return. It's a labor-intensive business that's difficult to automate. But now we get to the problem areas where jobs are not returning as fast or not at all. These are sectors we'll be watching very carefully at the local level. Manufacturing is an area where more automation is always possible. It's not as big a part of the economy as it used to be, but it provides good jobs. Healthcare is a more worrisome sector because it's much bigger and because there doesn't seem to be any improvement. And in the large government sector, things seem to be getting worse as local government finances are in poor shape. Manufacturing, healthcare, and government provide well-paying middle-class jobs, and extended loss of jobs in these sectors will weaken local real estate markets. Let's have a look now at some real estate markets with the opposite problem: more demand than supply and a surge in home prices. Here's what we're looking at, although Boise is just the most extreme example, with average home prices up 18% in the past year. On the chart, you see annual average home prices, which now are just under $400,000. I want to point out the red dots, which show a calculated price called the income price that says where home prices should be according to local income. It's a measure of how much a local market is overpriced and an important measure of the risk for investors. Here's what we worry about. Just recently, the average home price in San Francisco peaked at over $1.2 million, and it has since fallen 20%, with maybe more on the way. You could think of many reasons why this won't happen in Boise, but the income price has been an infallible, and I'll repeat that, infallible guide to overpriced markets. Investors must keep that in mind. That doesn't mean you can't invest there, just that the return you get can't depend on home prices going higher or even staying this high. Here are some other markets with a surge in prices during the past year. The middle column shows how much they're overpriced according to the local income price, and the far right column shows the current gain or loss of jobs compared to pre-pandemic levels. You could point to the strong job gain in Boise as justification for the surge in prices, although I think it's more to it than that, but that's not true in the other markets where jobs are still negative. I think it's more likely that the surge in most markets will not last and that prices will stall or even drop in those that already are heavily overpriced. Again, that doesn't mean you shouldn't invest there, but your financial strategy can't depend on higher prices. We'll find out in the next few months exactly what's going to happen. That's it. To finish, let me plug our Investors Metro analysis, which shows how local economic conditions affect investments in real estate, down to the zip code level, and with our special local job sector analysis. It's available for any of 200 markets and is easy to use as 1, 2, 3. Thanks very much for following along. This is our National Economic Outlook. I'm Inga Windsor.